Hello everyone, my name is Wei, and today I will be presenting on the topic of options contract, specifically covered call options. Please check out our derivatives playlist to get the basics of how options contract works. And without further ado, here is covered call options. A covered call position is created when a contract writer writes a call option while owning sufficient underlying stock in exchange for a premium. This is a popular entry into option strategy because traditional investors own stocks. The investor can capture premium by selling call contracts and capping the upside potential of the stock. The strategy is also low risk because if the contract gets exercised, the covered call writer will be obligated to sell the stocks he or she already owns to the contract owner, instead of having to buy the shares from the market to cover the exercise. Let's quickly look at the profit and loss graph for covered call position. Because covered call combines long stock position, which has unlimited upside gain, and naked call position with unlimited upside loss, the combined profit and loss graph becomes limited upside gain with maximum profit at the call strike. So how can an individual investor execute a covered call strategy? First, find a stock position in a portfolio that the investor is neutral to bullish on, preferably a stock that the investor has a firm price target to liquidate or sell the stock. And the next step is to check the options chain to find a contract that meets the covered call intention, and find a strike that meets the price target of the underlying stock and an expiration date with decent premium at the strike. The strategy for covered call is to hold on to it until the expiration. Like always, execute and stick to the strategy. There is no need to formulate an exit strategy because if stock moves down, then the maximum premium is captured. If stock moves past the strike, then the stock is sold at the price target. Here's an example on writing covered call on AT&T. Let's say I bought 100 shares of AT&T stock at 36.52 cents per share. That is $3,652 initial investment. It is a dividend stock that does not really explode upwards like growth stocks do, and it provides 5.45% dividend in a year, assuming they do not decrease the dividend, that is. I got this information from Yahoo Finance. Let's assume that I am neutral to bullish in AT&T because I am holding it to collect dividend and not expect a significant growth. So I will write a covered call on it to collect premium. After selecting my covered call target, I need to find a contract. So I pull out the options chain for AT&T with expiration date on June 2018, so I can collect the dividend for the duration of holding if the contract does not get exercised. I pulled this options chain off Yahoo Finance with link below the table. The first column shows the contract information with the symbol of the business, which is T, the time of expiration 2018, June 18th, and the strikes. The last time column shows the last time this table was updated, and the strike column shows the strikes, and the last price column shows the last price that was traded. Because each contract is equivalent to 100 shares, I actually have to multiply 100 to the last price to get the actual premium for selling each contract. The next step is to create a strategy. Let's say I predict that AT&T will be below $42 per share by expiration date. For AT&T to go to $42, that is 15% increase from the current price. So I will sell the contract at the strike of 42 and collect $42 per contract. As for exit strategy, I do not have to do anything because I will let the contract expire worthless and collect full premium, or if the stock moves above $42 per share, I will have to sell my AT&T stock at the strike of 42, which is fine because I will be able to obtain the 15% profit and the premium. Now let's create the scenarios for the price of AT&T on June 15th of 2018. And the scenarios are: stock price moves to $30 per share, which is 17.85% down move, $36.1 per share, which is 1.15% down move, $42 per share, which is 15.01% up move, or $45 per share, which is 23.22% up move. And here will be the results for each scenario. At $30 per share, the contract will be worthless, but the stock will have a loss of $6.52 per share, With 100 shares, that is $652 in loss. Since I collected $42 in premium, which is denoted by a negative value in fee, the real loss is $610, which is 16.7% loss, and that is lower loss compared to owning the stock without covered call. At $36.1 per share, the contract will be worthless, but the stock will have a loss of 42 cents per share. With 100 shares, that is $42 unrealized loss. Since I collected $42 in premium, this will be the break-even point. Even though stock moved 1.15 down, I did not lose a penny. At $42 per share, the contract will be worthless still, but the contract owner may or may not exercise the contract. If the contract is exercised, I will have to sell my 100 shares at $42 per share and have a realized gain of $5.48 per share. That is $548 total gain plus $42 collected in premium, and have a profit of $590, which is 16.16% return on investment. At $45 per share, the 100 shares I own will have $8.48 gain per share. But the contract owner will exercise the contract and force me to sell the shares at $42 per share. That transaction will take $3 per share from my gain and result in $5.48 per share gain, or $548 gain. Plus the $42 collected in premium, the result is $590 profit. Notice the return is the same as if the stock moves to $42 per share. In fact, as long as stock moves above $42 per share, I will have my maximum profit. Cover call caps the profit because the intention is to liquidate the asset at the strike point and capture the profit and premium. And this concludes call options basics. In the next video, I will talk about put options. Thank you so much for watching. In this channel, we present on investment topics with plenty of examples. We cover investment terminologies, value investing, speculative investing, investment mathematics, and investment tools. Share, thumbs up, and subscribe if you like the video.